definitions that are on the test at some point. They're specific and they're all on the test. So when we talk about a risk, it has two or more possibilities exist. So that's the risk. And they could word the question if it has one risk, if it has one possibility, is it a risk? True or false, or yes or no, right? It two have to exist for it to be a risk. And the risk, you're going to have a pure risk or speculative risk. Pure risk or speculative risk. The pure risk, the two possibilities are loss or no change. So what would happen in a pure risk? That will be the example of the hazard. If I plug in the wire, either it's going to cause a fire or it's not. That's a pure risk. I plug it in, fire happens, boom, we have a loss. I plug it in, charges my phone, nothing happens. That's a pure risk. We know exactly what the possibility is. The speculative risk, the two possibilities are loss or gain. On the test, they kind of refer to gambling as a speculative risk. So let's say Wheel of Fortune. Here's the story for you to remember, speculative. She went to Vegas, she played the slot machine, I put in my dollar, I spin, and two things are going to happen. Either I put the dollar in, I win, that's my gain, or I put the dollar in and I lost. That's a speculative risk. So you just need to understand the difference. Pure risk, loss or no change, the wire. Speculative risk, loss or gain, gambling in that. All of the risks and hazards, they're referring to insurance, right? That's the license we're talking about. So let's go to the word insurance, and you're going to have that on the test a couple of different ways, and sometimes they do try to confuse you. So when we look at the word insurance, it's referring to a contract. That is the key word, contract. You're going to see the word contract in many different areas, and they're referring to insurance usually on your test. Whether it's a collateral contract, a unilateral contract, it's all referring to insurance. So when you're in that section reading, understand the different contracts. But an insurance is a contract between two parties. That's the key, two parties. What is the role of the two parties? They can ask you. So it can be simple as how many people are involved in an insurance contract? Two parties. Or what are the roles of the two parties in an insurance contract? You see how you can have one thing and it can give you several answers. Well, the one party is the insurer, E-R. And the other one is the insured, E-D. I don't know about you guys, but 15 years ago when I was getting my license, I was foreign to insurance, and I'm trying to remember, is it ED or ER? What's the difference? I mean, literally, that's how simple it is. Now it's like obvious to me, for me, a no-brainer, but it wasn't in the beginning. So understand, when you get to the test, it will get confusing. So ER, insurer, is the company or the insurance company. So when you say who's the insurer, give yourself example. What insurance company do you have? Is it Transamerica, Pac Life? Is it State Farm, Farmers? It doesn't matter. That's the insurer. What does the insurer do? They indemnify against a loss. What? What is indemnify? What is the role of the insurance company? Well, here's indemnify. Indemnify will bring the client back to the same condition they were in before the loss. So, same condition, or the word whole again. So, here's what happens in indemnify. The insurance company, that one party, is bringing you back to the same condition before the incident, before the loss, with no intent of loss or gain. So, if the insured is insured, they said, no, we're not going to give you more than what it's worth, but we're also not going to make you lose any value. Well, here's the example for the test. They normally talk about like a house or a dwelling. And this is where a lot of people don't understand it. But let's say I did plug in that wire and it caused a fire and you lost the home. Well, the insurance company doesn't care about how much you owe on your mortgage. Their goal is to bring you back to the same condition before. And that same condition is to rebuild that home. And if they can rebuild that home with $350,000, even though you owe $700,000, they're bringing you to the same condition, which is the $350,000. Well, I owe $700,000. Well, they can't help. You had bad credit and your interest rate was higher, or you refinance your home and you owe more money. That's not their job. Their job is to make sure they can replace the cost of building that home again. So again, indemnify is bringing you back to the same condition, and that's what the insurer does. The insured, ED, is the person who's getting indemnified. So if I'm the insured, the insurance company is getting me back to the same condition. So just know ED is the person, ER is the company or the insurance company. And that's who brings the person back to the same condition. So you must know the difference between those two. Two other words people mix up is insurability and insurable interest. They tend to say, well, what is the difference between those? Insurability is the way of underwriting requirements. So let's say if someone says, ooh, they have high blood pressure, they got diabetes, they smoke. Now they got to see if you're insurable. You're kind of a high risk with multiple things going on. Or this person just had cancer. Let's see what type of cancer, when was their treatment, what did they go through? That's going to determine if they're insurable or not. That's insurability. Insurable interest, on the other hand, it says that this person has a financial interest in getting insurance on someone, because if something happens to them, they would be losing something of value. Here's the example. You just can't go get insurance on someone because you want to get insurance on them. Your neighbor, your dry cleaner person, your person who delivers your mail. You just can't say, they said I can get insurance on them. Well, what would you lose if something was to happen to them? If you don't lose anything of value, then you haven't shown an insurable interest. Well, on the test, who automatically qualifies for insurable interest? It's your immediate family. Who's your immediate family? Well, here they are. Your immediate family will be your spouse. You're married. It would be your parents. It will be your children, and it will be the parents' grandchildren. So parents, your grandparents could get policies on the grandchildren. That's your only immediate family, not the siblings, not the nieces, not the aunts and uncles. Those are extended family, and you have to prove insurable interest. Doesn't mean you can't get policies on them, but you have to say like, hey, they are not responsible. Or I want to do this as, cash value for my nieces or nephews or those type of things. So you have to prove insurable interest. That's a big one on the test. So don't confuse the two, because most people do. Now, all of those things we talked about, good, Leanne, all of those things we talked about is going to take us to the application. This is the part where people get confused. It seems simple, but it's not when you start to mix it in. And I like to give you a little scenario, hopefully to mix you up a little bit as well. So let's go. Let's give an example. And this is a play story. I like to say it's something like, oh, so sorry for your mom. This is a fake story. So let's say my mom wants to get insurance. And she comes to me and says, Melinda, since you're in the industry and I don't really know much about insurance, can you help me get insurance? And I said, of course. So the question would be, how many people could be on an insurance application? That's the goal. So you need to know who and how many and what the roles are. And here's the story for it. So my mom will be the insured, right? ED. She's the person that's getting the insurance. In this case, the second person would be the applicant, which would be me, because she wants me to help her get the insurance. And the applicant is the person making the application. And because I know about insurance, I'm going to help her out on the application by filling it out with her and her insurance person, right? So that would be the applicant, would be me. That's the second person. The third person is going to be the beneficiary, right? The third person is the beneficiary. The beneficiary is the person who receives the proceeds when the insured dies. The third person. The fourth person is the payer, whoever's paying the policy. And here's the fifth person. We're going to go down to the fifth person, which is the policy owner. That's an important one for the test, but also for you as an agent. The policy owner is the person who's entitled to exercise the rights and privileges on the policy. So it doesn't matter whoever the person is, if they're the owner, they exercise the rights. Well, what does that mean? Here's an example. Let's say my mom was married. She got married years ago. Let's say she had kids before she got married. She got married. She never changed it. He was the owner of the policy, her husband, right? He was like, oh, I own the policy. She paid it. He set it up and he owned it. Let's say they get divorced. Now she has cash that is accumulated in the policy and she wants to take money out. She goes to the insurance company. Can you withdraw money, for me? Can you send me my money in my policy? They come back to her, say, sorry, ma'am, you're not the owner. We can't send you any money. She said, well, how am I supposed to get money out my policy that I paid for? You have to go to your husband, who's the owner. She goes to the husband, ex-husband. Can you request money for me to get out my policy? He says no. And there's nothing she can do about it because he's the owner and he has the rights to exercise all the privileges. Now he can request money and take it for himself. Guess what? They have kids that she has kids does not by him. He can change the beneficiary from them to him. And if she chooses to stop paying, he can continue to pay and keep the insurance on her. So remember, the policy owner exercises the rights. Doesn't matter who it is, they exercise it. So you need to make sure if the policy owner is not the insured, that they really do have the best interest of that person. Here's a question. Here we go. The applicant and the policy owner. That's good. Tamisha, here's a question now. Hey, all on an application, say all of the following, the insured, here we go. The insured can be all of the following except. The insured can be all of the following except the applicant, the beneficiary, the payer, or the policy owner. The insured can be all of the following except the applicant, the beneficiary, the payer, or the policy owner. So I see payer. Let's see, payer. Beneficiary. On an application, the insured can be all of the following except applicant, beneficiary, payer, policy owner. So we got beneficiaries, we got payers. So we got two, payer, and we got applicant. All right. So that's good. All right, beneficiary. So let's see what the answer is. So think about you now. You're going to go get insurance. You're going to get some insurance. Here's the question. Could you do the application yourself? Could you be the applicant? Are you competent enough to complete it? Yeah, so you could be the applicant. Here's the payer. Can you pay for your policy? Can you be the payer too? You can pay for your policy, right? All right. Could you own your policy? Be the owner of it? All right. How about the beneficiary? If the beneficiary is the person who receives the proceeds when the insured dies, could the insured get the proceeds as the beneficiary if they're dead? Let's see. You guys, I'm going to that question next. So here's the beneficiary. The answer is the beneficiary. The insured cannot be the beneficiary. They could be everyone else but the beneficiary because the beneficiary gets the proceeds when the insured dies, right? All right. Let's go into beneficiary deeper, and it's going to talk about some of the things that Daniel and Tamisha just put in there. All right. There's 3 different levels of beneficiary. But here's the next question, is how many beneficiaries can someone have? Let's see what you guys see on that. How many beneficiaries can someone have? Let's see, 2, unlimited. Let's see. All right. So I see as many as they want. 4, you can have as many as you want. 3, unlimited. 3, survivorship for the kids. Whoa, we got some answers in here today. All right. So here's the key. It's twofold answer. So the key is it is unlimited. You can have as many beneficiaries as you want, but that's not the only part of the answer. So remember on the test, it's the best answer. If it had 2, 4, 5, unlimited or infinity, that would be 1. But if it says unlimited, but it has to equal 100%. So if I want 8 beneficiaries and I say 25, 25, 25, 25, 25, 20, give them all 25%, it's more than 100%. It doesn't work. So you can have unlimited, but the percentage cannot equal more than 100%. So if I have 2, it could be 50, 50, 30, 70, 60, 40. If I have 3, it could be 25, 25, 50, right? The 34, 33, 33. However you break it down, it could be 10 with 10% on each person, as long as it equals 100%. So unlimited, as long as it equals 100. There you go. It has to equal 100%. So that would be the answer to that one. Now, there's 3 levels, because sometimes that mixes people up. There's 3 levels of beneficiary, and let's go to the 3 levels. So the first level is going to be a primary beneficiary. And the primary beneficiary is the first person to receive the benefits. So how many primary beneficiaries can I have? Unlimited beneficiaries that are primary, right? It's the first level. But it can say, hey, my spouse, he's at 100%. It could be my spouse and my kid, 50-50, right? And that's okay. Here's the question. So what if my mom has kids and she has her husband now? Let's say she has 2 kids and she's like, oh, Melinda's fine. I just want to be able to leave something to the other sibling. But her husband is down as 100% as the beneficiary. Okay. Something happens to him. He passes away. Then she passes away. Who receives the proceeds? Let's see. Husband is 100% on the plan. He passes away first. Then the insured passes away. Who receives the proceeds? Who is now the beneficiary? I see kids. I see second level of benefit, but she didn't put anybody else down. Kids, the children, the kids. Yeah, kids. All right. So here we go. Or the estate. The children, next to kin. Oh, look at these answers. Estate. All right, so here we go. If they had a second level, which is the secondary beneficiary or the contingent beneficiary, it would go to them, but they don't. So there's the word you guys are saying. Some people say the estate. Well, how many people actually have an estate? Only if the estate was the beneficiary. So you can say, hey, here's my trust, here's my estate as the beneficiary. Then if something happens to her, doesn't matter who passed away first, the estate gets it, and then they dictate what happens. But how many people have a will or a trust? That have a trust or have an estate? They don't, right? If there's no secondary beneficiary, it's only a primary, it is going to probate. Yes, it is. Exactly right. It's going to probate. So now the judge has to determine who's going to get it. What if she did have kids, but they didn't like the kids? The kids didn't take care of her, didn't do anything, and she wouldn't leave them a quarter, and she wants to leave it to the grandkids. That's where the judge is going to do it. So it's important, yes, to make sure you have all those extra layers. So if I have a primary person there and it's only one, you for sure got to have a secondary. If I have a primary and it's 2 people, let's say she did have the husband and one of the kids. Something happens to the husband, then the kid would get the whole thing because they're in there already and it will go to that person. But if there's not, it will go to the secondary beneficiary here, which is the second person to receive the benefits upon death, right? So not the second in the primary, but if all the primaries no longer exist, it goes to secondary. And then there's the tertiary level, which means if at any moment something was to happen to the first group of people, the second group of people, it would be tertiary. So you need to plug in your life so you know for the test what it is. So primary most of the time will be a spouse, secondary will be the kids, and then tertiary normally is the grandkids. What if you say, well, I ain't married? Well, then most of the time your primary is probably your kids, secondary, right, grandkids, and then you might have nieces and nephews as tertiaries. So you plug it in, so when you see that on a test, you know, first is them, second is them, third is them, and you'll remember those things, right? So it is the different levels of that. All right, moving on to underwriter and underwriting. This is where people mix that up as well. Tertiary. So if you're in another state and they don't mention it, then you're good to go, but it's in your reading. But if it's not in the glossary, it's in the reading. But it's the third person in line to receive it. And also secondary, remember the second word is contingent beneficiary. They can use secondary or contingent for the second one. So underwriter and underwriting, people actually mix it up. When do the trustee intervene? Only if the trust was the beneficiary. So let's say you could have had somebody as the beneficiary and not the trust. The trust has no say-so over that policy. That policy goes to the beneficiary. If the trust is the beneficiary, then in the trust, it would say what you want it to do. If it doesn't say, then that's when the trustee or the executor would decide where the money goes. So that's why it is important to have it. And then whoever's over it, you know, they're going to make the right decisions no matter what. So underwriter and underwriting, two different. The underwriter, let's start with underwriting first. Underwriting is the process of reviewing. We went over that application, we submitted it, now it's in the underwriting process. In the underwriting process, they may request different things to make sure the person could be insured. The underwriter, ER, person, is the one who accepts or rejects, so approves or declines on behalf of the insurer. So this is what happens on the test. They'll say who accepts or rejects, who approves or declines the client. Is it insurance company A, B, C? And they'll give you all these criteria. And most people say the insurance company. And that's not the answer. The underwriter decides to approve or deny or accept or reject on behalf of the insurer. So the answer would be the underwriter determines to insure or not insure them. Question: if the owner and the beneficiary died in an incident, who will be the beneficiary? They would need a secondary. If they had a secondary, it would be the secondary. The owner doesn't matter. The owner doesn't get any money on that if they're gone. And if they don't have a secondary, it goes to probate, and then the judge determines who gets it. That's how that one will go. All right, so now we get to go to the key facts. We're moving on. We're finished with the glossary. We're going to the key facts. Here we go. We're moving on down. We're winding on down here. All right, so we got that. We done that in the glossary. All right, now we're here in underwriting. So when that underwriter determines it, right? So we put in the application, and here's the first part that happens. Two things where people mix up, and it happens in underwriting. Guaranteed on the test is there's a report that's pulled, and it's called the MIB. It could be as simple as what does the MIB stand for? Medical Information Bureau, simple. Or what is it? It's actually a report that it's mandatory that any insurance company reports any impairments or findings they got when somebody applied for insurance. So sometimes clients go from insurance company to insurance company to insurance company. They know they have to report it. So here's a question coming. On the application, it tells us, it asks us, has your client applied for insurance the last, and depends on the company, 3 months, 6 months, or a year? And you ask the client, and the client says no. So you submit the application. The insurance company comes back and says, Melinda, our sources say your client applied for insurance 6 months ago. Can you please update the status? Is it enforced? What was the coverage? What's the rating, right? And you go back to your client and says, hey, Mr. Client, the insurance company said you applied for insurance 6 months ago. The client says, no, I didn't. They said, well, they said they have sources that say you applied. No, I didn't. Okay. You go back to the insurance company and say, client said they didn't apply for insurance. The clients, the insurance company say they're a hazard and they decline them. What kind of hazard is that person to the insurance company? Let's see if you guys put the dots together. Oh, I see more. Oh, you guys caught where I was going. Moral. Moral. They're a liar. Misha says liar. Yes, that is correct. They would be a moral hazard. They could be in the best health possible, but because they lied on the application, they will be declined for insurance. So the answer should have been, yes, I applied, but I canceled it. I didn't go through with it. I didn't like the agent. It was too expensive. Whatever it is, just give the answer. And you as the agent, if the insurance company says it, they have the information, and make sure you go back with the appropriate answer. So that's the MIB. People mix up the MIB with HIPAA. HIPAA and MIB are different. So HIPAA deals with protected health information. So the insurance companies on the MIB, it doesn't matter. It's mandatory. It's law. They have to report it. They found out you got diabetes. They got to report it. They found out you got cancer. They got to report it. But HIPAA on the other end is when they request the information. It's protected. So if the underwriter says, I need to get information from your doctor. Well, on the application, there's a HIPAA form that the client signs that authorizes the insurance company to get information on them. So then they send that to the doctor's office and they release it. If the doctor's office ever released information and they didn't have a HIPAA form, they could be sued. So that's why it's important to understand HIPAA. They cannot release the information. Now, here's a side note and on the test for you guys. I'm a nurse practitioner licensed, and I'm under HIPAA no matter what. I understand it. I could have all kind of clients, people that are friends that come. I can't say anything. You're licensed. When you get licensed, you're also bounded by HIPAA. And you're going to have friends and family that are going to get insurance through you. And you're going to find out personal information. Even if you tell it by accident, you could be sued. Let's say you found out a family member had diabetes and you guys are at a barbecue or at a picnic and they're going for dessert. And you're like, are you supposed to be eating that dessert? You got diabetes. And someone hears you and now the client is embarrassed, they can sue you. So you can't say it. High blood pressure, cancer, anything they could have had in their history, you're bounded by HIPAA. So HIPAA protects the health information. So don't get those two mixed up. Now, once the underwriter has everything, they're making a decision. They decline you. That's it. You're declined. You don't qualify. Maybe you can go through a different company. But if they approve you, the approving is going to be with 3 different type of categories. Let's see, I got a question here. Let's see. Is it likely on the exam they will put MIB and HIPAA as both multiple choices? Yep. You will see them separate and together. So they would definitely try to make it where it sounds alike for sure on there. Okay, what about if you know because your client is family and the client fails to disclose it? That's a catchy one because on the question, this is why too, we like to say, someone else should be writing your close friends and family because you do know personal information. And there's a question on there that says, do you know of any information not disclosed on here that would prevent them from getting insured? And if you know it and you don't say yes, you could be in trouble. But your agent, if the client doesn't tell your agent, they don't personally know them and they wouldn't know it. And then if they got approved, they got approved. So that's why it's important. A lot of times you're like, hey, you writing up my friends and family because I'm close to them and someone else can be that middle person on there. So that's how come that works that way. So when the underwriter gets ready to approve you, here's the risk. You're going to be preferred, standard, or substandard. So that's going to be, they're going to say you're preferred, standard, or substandard. If you're preferred, it's going to be the cheapest are the lowest charges because it has the lowest risk. So it's the cheapest, the lowest charges, because the lowest risk. If it's standard, it means you're average. So admit, they say, okay, Melinda, based on your height and weight, based off of your blood pressure, your cholesterol, your sugar levels, your glucose levels, you're going to be rated normal, average, or standard. If someone's better, if they say, Melinda, your cholesterol is better than the average person, your glucose level is better than the average person, your height and weight is better than the average person, then they rate me preferred. If they say, Melinda, your height and weight is a little bit more for the average height and weight, it's your person, your blood pressure is a little bit higher for your age, your glucose level is out of range, then they can rate me substandard. So preferred is the cheapest, substandard is the most expensive. Now, they could have easily declined me, but instead of declining me, they just rated me higher and made me pay more money. So understand, you got preferred, standard, and substandard. And just know preferred is the cheapest, substandard is the most expensive, and average is the normal amount that someone would pay for that. All right. So here's the life insurance policies and annuities. This is a big section. So we want to make sure you guys understand this section. So no matter what goes on, this is the section you guys want to make sure you understand, right? So you're going to read it, you're going to understand it, all those things for it. But here's the summary of it. So let's get the group one out the way since it's first. Just remember, there's only like 2 questions on group, 3 the max on group plans. So one is, how many employees does someone have to have for it to be a group plan? They can ask it that simple, right? And the answer would be 2 or more. Well, they can take that question deeper and say, does the owner qualify as an employee? And here's the question for the group coverage. If the owner gets paid a W-2, they will be considered an employee. So the answer could be yes. But a lot of times the owner can say, I got 2 employees and I don't pay myself. Or I got 1 employee and I don't pay myself. Well, that wouldn't be considered 2 employees. So you have to know 2 people getting W-2, and one could be the owner as long as they're both getting W-2. That's going to be the difference in that question. So it is 2, and then they'll ask you sometimes, can the owner count as one? Yes, as long as they're getting a W-2, they can. All right. So here's the next one. They'll say the age. How old can a child be and stay on the group plan? Well, the age is still 26 now. So they can be 26 years old, the child, and stay on the plan of the parent. There's another question in that section. What does the employee receive as proof of coverage of insurance? And the answer is on your screen. It's a certificate of insurance. That will be, what does the employee receive as proof of coverage? The answer is a certificate of insurance. Now, here's one way the test actually works. There's a lot of times you may have a question and you don't know what that answer is. Mark an answer, mark the question, so you can always come back to it. Many times you're going to get the answer in another question. This will be an example of it. Another question could read, on a employee's proof of certificate as proof of coverage, what is included in it? Well, if I didn't know they received a certificate of insurance, now I do. And the answer to that question is, what's on the proof of coverage, that certificate, is just a certificate number. So on that proof of coverage, it's only a certificate number. It doesn't tell you the amount of coverage, doesn't tell you anything. That's why a lot of times employees don't know how much coverage they have, because it's not written on their certificate. The information is on the employer's document. And here's the question for the test. What does the employer have as proof of coverage? The employer has a master policy. So employee, certificate of coverage of insurance, employer, the master policy. The master policy has all the information. Employee's name, it has the the insurance amount, the cost, all of that is on the master policy. So that's for your group plans, and that's it. You wouldn't even have to read that section. That's all on employee stuff, pretty much, right? Group plans, I should say. All right, moving into the big part, insurance, types of insurance. These are big on the test, and we're going to go over them. But here's the key too, is reading the words in the question properly. So if you see here, this says 3 types of ordinary life insurance. Now, if I'm not paying attention to the word ordinary and you answer the question, you can answer it different ways because there's a lot of different types of insurance policies, but there's only 3 ordinary life insurance policies. So again, sometimes we read the question quick and you know the answer, but you read it so quick and they always have an answer in there that seems like it's right on what you thought the question was asked. So always read the question twice because certain key words are going to help you answer the question correctly on there. So 3 types of ordinary life insurance. Here's the answers: whole life, endowment, and term. Whole life, endowment, and term. They like to use the acronym WET, W-E-T. But also on the test, the word endowment is interchanged with the word universal life. So when you see endowment and universal life, they're referring to the same identical thing. But for the test and for you to memorize it, they want to use the acronym WET, whole life, endowment, and term. Here's a test question. All of the following are types of ordinary life insurance, except all of the following are types of ordinary life insurance, except term, endowment, group life, or whole life. Term, endowment, group life, or whole life. So all of the following are types of ordinary life insurance, except term life, group life, endowment, or whole life. Let's see what we got. I see group, group. All right. And that was given because it's on the screen, right? That one was a given one. It's on the screen. And it is true. It says group life, group insurance is not an ordinary type. Neither is accidental, neither is dismemberment, neither is none of those. The only 3 is those 3 types. And Tamisha, we're going to get to the universal life and the index and what's the difference in that. That's going to be coming up when we go diving into it, which is very soon. So if we talk about it, let's divide those up into temporary and permanent. So the term is temporary and the permanent is the endowment and the whole life. That's the permanent policy. The term is going to be exactly that. There's certain words that go with that, like 10, 15, 20, 30 years. And we'll talk about that one last. And then you have the endowment and the whole life, which are permanent. There's things that make them similar and there's things that make them different. How are they similar? They're both permanent policies. As long as you pay into the policies like you're supposed to, you'll have the coverage and they'll pay out to the family. What makes them similar as well? They both build cash accumulated in the policies. What makes them different is how the cash accumulates in the policies, which we'll talk about in there. So let's talk about whole life. When you see the word whole life, think of the word dividend and paid up insurance. When you see dividend and paid up insurance, think of whole life policies. That's what that's referring to. Dividend and paid up. And we're going to talk about that as well, Daniel. And the answer is no. Term does not accumulate cash, right? And we're going to talk about the difference as we get to that one as well. So dividend and paid up insurance is going to be whole life. Now, let's say how it works. Whole life policy does accumulate cash, but it accumulates it for a different reason than the endowment accounts. So let's say we have insurance and I have a whole life policy. And let's say I have $100,000 of insurance and I pay $100 a month for that policy. What that $100 does is it's going to take out the cost of insurance for that month. And then they're going to take a little bit to put it towards the cash. Now, in the whole life policy, when it's paid up, they're going to tell you 20 years, 10 years, 20 years, 30 years, or your life. That means if you pay into the policy, let's say it's a 20-year paid up, you pay into the policy for 20 years and you don't have to pay into the policy anymore. Guess why? Because the cash that's accumulated in there is going to pay for the policy for the rest of the time. That's what's supposed to happen in the cash in the whole life policy. But because it is cash, the person has access to borrow that money, and they can. But they're supposed to pay it back because it needs to pay the policy to keep it going. If they don't pay the money back in that policy, it could lapse, LAPSE, which means if I don't pay it back, I no longer have insurance. Here's the scenario of that. Let's say we have a grandmother, and most of the time who has these type of policy, it is older people. Let's say the grandma had the policy and she paid into it for 20 years. And for some reason, she took the money out. Let's say she got her a new cupcake and she traveled the world with him, but didn't tell the family. She passed away. The family finds this policy. They call the insurance company and say, my grandmother passed away. We want to go ahead and get the benefit. And they say, sorry, her policy lapsed. And he said, what do you mean? It's paid up for 20 years. Yes, she took the money out and she didn't put it back. So it lapsed. So remember, paid up policy is paid up as long as the cash is in there. If you borrow the money, you're supposed to pay it back. If it didn't lapse, they would deduct it from the death benefit. So let's say I had that $100,000 policy and I had $10,000 cash. I took the $10,000 out and then I passed away. They're not going to give my family the $100,000. They're going to take the $10,000 from the $100,000 and pay the family $90,000. So that's the whole life policy, right? That's how that one's going. Yeah, sneaky grandma. That's how the whole life policy is going to work. Now, the universal life is going to work different. It's meant to build cash and it's meant for you to be able to take money out. So here's how they're going to ask you on the test. So you're going to pay the $100, the same $100,000, and you're going to pay $100 in it. Here's how it works. They're going to subtract the cost. How do they determine the cost of insurance? The mortality and the general expenses is the cost. Let's say the cost of that $100,000 policy was $75. They're going to take the difference, which is $25 in that universal life policy. They're going to add, here's the key, current interest to that $25. Then they deposit it into the cash. Remember, whole life didn't build any interest. The universal life is going to build interest and then deposit it into the cash. This is to your question, Tamisha. Answer to your question. When you see the word current interest, it's referring to a universal life and it's a fixed interest rate, 2-3% interest. Whatever that current interest is, you get credited. If it's the index universal life, it's going to mirror an index, S&P 500, Dow Jones. Unlike the market did, it's not invested in the market, it mirrors it. The market drops, you get a floor where you never lose anything. If the market gains, you're going to get the gain, but you never suffer the downside of it. So that's the index growth. And then you see the word variable universal life. That one's actually in the market. If they have the mutual funds or the stocks or whatever they're invested in, market goes up, money goes up, market goes down, money goes down. That will be the variable universal life. So 3 different types of ways the money grows in the universal life. The fixed, which is just the universal life, current interest, 2-3%, whatever it is. The index, which is going to mirror the index and credit it whatever the index does. And the variable one, which is in the market. Yep, that's right, Tamisha. And the fixed, they call it current interest. Those 2 words could be interchanged on the test. When you see current interest, it means a fixed interest rate on that. Now, both of them, when you take money out, here's the great part, that tax code 7702A, you don't pay taxes on the money regardless of whichever one you have. You don't pay taxes on the money. So that's the good part about that. Now, here's another question. On the test, they're going to say who regulates all insurance products. And the answer is the state, whatever state. That's why we all have to take our state test. This state test is like this. Every state test is a little different because they regulate it and they throw whatever extra state criteria they want in there. Whenever you see the word variable, who regulates that? You're going to have another person added, and it's the SEC, the Securities and Exchange Commission, regulates anything with the word variable, anything attached to the market. So it will be the state and the SEC. And do you require another license to be able to do variable products? Yes. So I am securities licensed and I can do variable products, and I'm regulated by the SEC. So the answer is yes, the state and the SEC regulates anything variable in the market. The state will regulate everything else. If it's variable, the SEC also regulates it. That is a test question. How do you know when it's variable? It either says it, or when you see the word, 3 words, accumulation, sub-accounts, or you see the word variable. It can say variable, right? So accumulation, sub-accounts, or variable, those are going to be words for variable products. All right, so let's go into universal life. Now we're continuing. There's 2 products that you'll be tested on. One is going to be the joint life, and it covers multiple lives in one policy. But here's the key. It pays when the first insured dies, the first person dies. So let's say I'm married and me and my husband don't have any kids, don't have anyone we want to leave any money to, but we live together on each other's income. And if something was to happen to one of us, the other person would not be able to continue the same life. So we don't need to leave money if something happens to both of us. We only need money if something happens to one of us. So we both are in the same policy, and it's going to make it cheaper than if we had 2 separate policies. If we had 2 separate policies, here's the example. Let's say I had $250,000 of insurance. He had $250,000 of insurance. If he passes away, $250,000 pays out. If I passed away, $250,000 pays out. Something happens to both of us, $500,000 will pay out. So we're paying for more insurance. But if we have a joint life, it's going to pay out only when the first person dies. Because when the second person dies, we don't need to leave anybody any money, so we don't need to pay for that coverage. That is joint life. Survivorship life is different. It's going to pay when the second person dies. So now you get this one for a different reason. And in that case, the survivor would have to get another policy. No, the survivor would get if they wanted to leave it to someone else, but they normally don't want to leave it to someone else. That's why they don't get that type of policy. That's why they both didn't get it. They only need it for when they're living. When both of them are gone, there's nobody to leave any money to. So they don't pay for that. They don't have family. They don't have kids. They don't need it for the survivor to leave money to someone else. It's only when the first person dies, my husband passes away, he leaves me money. When I pass away, then there's nobody to leave any money to. There's nobody to leave it to. So we don't get insurance on the second person. So you would only older people tend to get this one. So somebody that's young and like we don't have kids yet, but we might have kids, they wouldn't get a policy like that, right? This would be later on. Okay, perfect. So the survivorship life would be the different. Now we got kids and we're wealthy. We have money. So I don't need his money if something happens to him, and he doesn't need my money if something happens to me, but we have an estate worth millions of dollars. And you guys know there's taxes on the estate. And if something happens to us, our kids would have to have millions of dollars to get the estate. They got to pay the taxes to get the estate. So a survivorship plan is going to say, here, we got insurance, but we don't need it until the second person dies. Then it's going to go to our kids, and they're going to be able to pay the taxes in the estate and inherit all of our money. So survivorship pays when the second person dies. The joint life pays when the first person dies. Let's see the question. Joint pays one or other, or if both die. Joint life only pays on one. Yes, joint life only going to pay on one. And then the survivorship life is going to pay when the second person dies. So both have to die in order to pay out on that one. And the joint life, you are correct. If we both die, that's it. It's not leaving it to anyone else. The beneficiary will be the other person on there. All right. So let's go to term. So term life. So let's start with the question, the first person that we had earlier. Term does not build cash. It's only going to pay out insurance once the person dies within the time frame, 10, 15, 20, 30 years. If you don't die within the time frame, you don't get any coverage paid out to your family. And that happens 98% of the time. You get a term policy, it doesn't pay out. But because of that, that makes it cheap and inexpensive, right? So they said, which one's more expensive? Of course, permanent is, because 100% of the time, as long as you pay, they're going to pay out to your family. 98% of the time, the term policy is not going to pay out to your family. That's why it's cheap and inexpensive, right? Because it's cheap and inexpensive, you tend to be able to get more death benefit. So at the time, more death benefit might be more important to you, and then it's cheaper to be able to get the coverage. So sometimes it may ask you on the test, who could get more coverage with the same dollar amount? As both the same age, is it the person with the temporary policy or the person with the permanent policy? It could be simple like that, knowing which one's going to cost more. If someone's going to go with there we go, Tamisha, a temporary policy, you're going to get more coverage than you would with a permanent policy. So as simple things like that, the questions could come up in that answer. But let's give you an example of a policy. Let's say I'm 20 years old. And at the time, I don't have kids. So this is kind of one of the questions someone had, what about if you get kids? That's what we always prepare for, the what if. We can get them covered now if they plan on having kids. Our strategy is different than if they're like, I'm never going to get married, I'm never going to have kids, but what if they do? So we still stay in the person's life to adapt it. But let's say I'm 20 years old and I sit down with someone who only has term policy and they're like, here's a 30-year term for you, Melinda. By the time you're 30 years old, you're going to accumulate money, you're going to be working, you're going to be in a different position, and they're selling me on why it's great. And so I don't think of anything else but that policy. So I'm 20 years old, I'm preferred, I'm in good health, and it's cheap. Here we go. 30 years later, I'm about to turn 50. Now I'm married and I have children. And my policy is about to end. Before I turn 50, I go to the doctor, get my nice clean bill of health. Go to the doctor says, sorry, Melinda, you have cancer. Now I'm diagnosed with cancer and my policy is ending. I have cancer, my policy is ending. Guess what? I no longer am insurable anymore. I have a family and kids and I cannot get insurance. That policy ended. That is just a term policy. And there's companies, not to badmouth anybody, but that's Primerica's term. If you have an insurance company that only has term, that's it. When that term is up, it's over. There's no more options. But if you're with exactly, Tamisha, decline. Now, if I'm with a company that gives me that term policy, but it's convertible. Now it says, just in case you have kids, you get issues, anything, you can convert it to a permanent policy and don't have to requalify for it. So the scenario would go, if I had a convertible term, the policy would go like this. Now I'm about to turn 50. Now my policy is about to end. I can convert it to the permanent policy, even if I have cancer. And guess what? They cannot decline me. They have to convert it to a permanent policy because that's the policy I signed up for. That is a convertible term. Now, here's the question they ask you on the test to try to mix you up. What percentage? Let's see, I'll get to those. So here's the question that they try to mix you up on the test. Will the cost of the insurance go up when you convert it? And sometimes people think it's a tricky question, but the answer is yes, right? But what But the reason why it goes up is different. So sometimes people say it's because she has cancer. No, your health issue doesn't have no significance on the price. Because if I'm 20 years old and I'm preferred, when I convert it over, I'm going to be 50 and preferred. So I'm still going to have a preferred rating. But here's the difference. I'm no longer 20, I'm 50. So I'm going to have the cost of a 50-year-old preferred in a permanent policy versus a 20-year-old preferred in a temporary policy. So the price goes up because I'm older and it's permanent, not because of my health reasons. So make sure you understand that, because they're going to throw that in there and you're going to think the cost is higher because of the health issues. No, if I was preferred at 20, I'm preferred at 50. If I was standard at 20, I'm standard at 50, right? So that's going to be the difference in that one. All right, so let me see. I see a couple questions. What percentage of the premiums paid would carry over? No percentage. Term is term. You're only paying for insurance. There's no cash accumulated. There's nothing. So all those years you pay into term, that's it. That's why when people are younger and permanent is cheaper and inexpensive, you lock in those cheap gains there. But sometimes if you don't have those products, people don't offer it to them, or because people are younger, they don't see it. So the sooner you can convert it to permanent, the better. So you can start to pay into the permanent policy. That was for you, Tanisha. So get term with convertible for young kids. Yeah. And all, just so you guys know, all the term you offer is convertible. When we say young kids, we're talking about young adults. Kids can get the permanent policies like the Rockefellers. It's dirt cheap. They're young. It's inexpensive, right? The cost of a kid's policy is way cheaper and the cost never goes up because they're young. That's the beautiful part about it. All right. All right. There we go. Dig say, what's the point if no money is accumulated? So it's the insurance. That's why it's cheaper and the person is paying just for insurance. So let's say if somebody says, here's your $100 policy, like I just gave an example in our crusade class. This person was younger and they paid $24 for a term policy, convertible term, but it had living benefits too. They was like, I'm just helping them out. I'm gonna get some coverage. And it was a $500,000 policy. Well, in July, she's 47. She got diagnosed with brain cancer. She died. What if she didn't have any coverage? She couldn't afford more than $50. So really, she gave them the budget of like 25 and they got her temporary coverage. So 4 years later, she gets brain cancer and there's a $500,000 that pays out. So the key is to give people coverage, but make sure it's convertible. But as soon as they something permanent, you get them into something permanent as soon as they can. So you rather have them have something versus nothing at all times. All right. Yeah, just to be assured, living benefits. All right. So now let's move on to, so that's convertible. Let's go to annually renewable term. Now here's an example. So let's say Jared now is like, I'm about to get insurance. Melinda, I told you I'm about to get my insurance here. I got my license now. Let's sit down. I'm ready to write you up. You promised me. I said, okay, no problem. So I go to my husband and say, hey, Jared finally got his license. We promised him I was going to do our insurance policy with him. He said, okay, no problem. But you know, our friend Kevin does insurance. And if we don't give Kevin an option to beat what Jared does, he's going to be mad at us. No problem. So Jared comes back and says, hey, Melinda, here's $250,000 of this term policy for $100. He was like, I know I got the biggest and the best companies and it's cheap. No problem. So we go to Kevin and Kevin comes back. You thought that Jared guy was good. I got $250,000 for $75. And I come back to Jared. Jared, what happened? And Jared's like, wow, I thought I had the best. I can't beat that. Well, this is why you always tell people to show you the policies so you can compare apples to apples. Jared policy was a 30-year term that was going to stay the $100 for the $250,000 for the entire 30 years. It's called level term. 30 years, same price, whole time. Kevin put us in an annually renewable term where Kevin told us, he didn't say that, hey, you guys, I'm going to start you at $75, but every year your premiums are going to go up. That's annually renewable. Death benefit stays the same. So by the time we're 30, instead of paying $100 like Jared was signing us up for, we're paying like $1,000. So at some point we would have canceled that policy because he didn't set us up with the price. So just because someone starts them cheaper doesn't mean it's the same and the best. You have to make sure you're comparing apples to apples on that. Does the rating stay? The rating stays the same on those terms. Yes. So that would be annual renewable term. Decreasing term, we consider it to be mortgage insurance. So if someone says, can you do mortgage insurance? The answer is yes. And it mimics the mortgage. So let's say you have a mortgage that you owe $250,000, stick with the same number. And you have 15 years left, right? Whatever the time frame is. Whatever your mortgage payment is, let's say it's $1,500 a month. You're going to pay the $1,500 a month, but your mortgage, which you owe, is going to go down over the years. The term, decreasing term, works the same. They're going to say, here's $250,000 to start with, and here's your payment of $100. You're going to pay the $100 the same the whole time, but that $250 is going to go down over the years because it's going to mimic your mortgage. But if you refinance the mortgage, you're still only going to pay out what you signed up for. So decreasing term, here's the recap. Decreasing term, death benefit decreases, payment stays the same. Annual renewable term, death benefit stays the same, premium increases. Level term, death benefit stays the same, premium stays the same. You must know the difference because you will have that on the test. So here we go. Level, death benefit, premium stays the same. Annually renewable term, or also known as increasing term, death benefit stays the same, premium increases. Decreasing term, death benefit decreases, premium stays the same. Remember, that section is a big section and really knowing the ins and outs of insurance. So make sure you guys review that. All right, we're moving on down because we're winding down to the last 30 minutes. Here we go. Here we go. All right, annuities. This is a bigger section too. This one has quite a few questions in it, maybe like 4 to 6. And it's all around the same sort of concept. But here we go. What is an annuity? Annuity is protection on your money. Think of it like a pension plan. The people work for all those years to get a pension plan is going to pay you income for life. That's the whole point of it. So here's the options. Let's say I go to my job and I'm a retire and I put in my retirement paperwork. And they say, okay, Melinda, here's your options. You could take the lump sum of money, or do you want monthly income for life? I'm like, I can't take the lump sum of money. I don't know where to go with it. You're going to pay all the taxes on it. No, give me income for life. They say, okay, here's your options. You got $3,000. We're going to give you income for life. I'm like, dang, that sucks. All these years for $3,000? Yes. So, okay, well, what happens if something happens to me? What does my husband get? Well, if you get $3,000 a month, Melinda, your husband gets nothing. But if you pick $2,500 a month, then we're going to give your husband so much left over. Oh, I can't live off of $3,000. Never mind. So they picked the $3,000 instead of the $2,500. Here's the key. What if I had $1 million in that pension plan? 500,000, doesn't matter. And I pass away the next year. My husband would get $0 because that's the option I picked. And just think, every day, every 7 seconds, someone's turning 65 and making those decisions, but don't really know if it's the best decision for them. What if I got health issues? I shouldn't pick that option because I may not be around in a year or a couple of months. But you guys don't have your license yet, and you can't talk to those people. You gotta get your license. These people need you, right? So here's the option. That's one. Whenever someone does take the role of the option to take the lump sum, or you have a 401k, a 403b, a TSP, a 457, and we call it a rollover. You take the money from your employer, and you make it your individual retirement account now, and you roll it over into an annuity. That's normally what happens. Now we're putting guarantees and protection on your money. Side note, a product you guys have access to can give 25% bonus, 10% guarantee no matter what the market does. If the market does better, they get the better of the two. There's some with 35% bonus. There's some with less bonus, more growth. Yes. With your license, you're going to be able to roll money over and give people the best of both worlds with safety and growth. They're going to love you for it. On the test, this is what you're doing. So you want to know real world and test world. Here's the test world, and this is what they're going to ask you. So they're going to say, here's a 10-year period certain annuity payout. let's make sure we understand this. The annuitant is going to get payment for life, period. Once you start to receive your monthly income, whatever that is, it's income for life for the annuitant. But the money that's left to the beneficiary is going to be based off of the period you pick. Here's the example for the test. It's a 10-year period certain annuity. So if the annuitant, let's say I'm the annuitant, passes away before the 10 years is up, they're going to give my beneficiary whatever time frame is left. So on the test, it's going to be years or payments. How do we determine payments? There's 12 months in a year, which means there's 12 payments in a year. If I have a 10-year period certain annuity, that means 12 times 10 is a total of 120 payments that will be available to my beneficiary. So here's the test question. They're either going to do years or payments. Let's do years. Melinda has a 10-year period certain annuity. She received 3 years of benefits. How much is left to her beneficiary? Melinda has a 10-year period certain annuity. She received 3 years of benefits. How much is left to her beneficiary? See what you guys got in the chat. Melinda has a 10-year period certain annuity. She received 3 years of benefits. How much is left to her beneficiary? Let's see. Nicole says 7, Daniel 7, Leanne 7, 7, 7, 3, 7, 7, 7, 7. Okay. So if my beneficiary gets, if 10 years is the most my beneficiary can get, if I receive 3 of the years, that means if something happens to me, they get what's left. So it's 7 years left. So it's 7 years left. If I receive 3, it's 7 years left. You got that one now? So they have to pay. Yes, they have 7 years, not the beneficiary. The annuity company now has 7 years of benefits they would give to my beneficiary. Got it. Okay, perfect. All right. So here's the payments. Melinda has a 10-year period certain annuity, and she received 20 payments. How many payments is left for her beneficiary? Melinda has a 10-year period certain annuity. She received 20 payments. How many payments is left to her beneficiary? Let's see. Let's see. Okay, Melinda has a 10-year period certain annuity. She received 20 payments. How many payments is left for her beneficiary? There we go. The answer is 100. And let's say if they told you it was a 10-year period certain, but they didn't tell you how many payments, you need to know there's 12 payments in a year. 12 times 10 is 120, and then figure out the difference. So just know how they come up with payments. If it's years, give them the year answer, not the payment answer. Payments are definitely more specific. They may say that. Which one is more specific? It's payments. Because I can say year 1, but what if I receive 6 payments in year 1? It'll be 6 left. So payments are definitely more specific to that. All right. Moving on, you guys see the word variable annuity, same thing. See the word accumulation and subaccount? Those are those 2 words for variable. Variable annuity is regulated by the state and the SEC. Here's the equity index annuity. I want you guys to catch it. This is in writing. It's with your license. The index annuities provide a fixed minimum interest rate here, and then they have a chance to get the higher rate of return. So no matter what, you got the guarantee where you never lose anything. And yet if the market does better than the index, then the fixed rate, then you're getting what the index does. That's huge. You know, that's what the people are saying. I want my money safe, but I want it to grow. That's exactly what that provides, and including getting the bonuses and everything else. All right, so those are great things for you guys. All right, moving on to the free look period. Here we go. Let's say this is when you have a policy approved. Now you have the delivery receipt. Here's the 2 components that are important. for the free look period to be triggered. You need a signature and a date. A signature and a date. You can have a signature because no date is not valid. You can have a date and no signature is not valid. You need both of them. Once the client, whether electronically or the physical delivery, once they sign and date the delivery receipt that they received their policy, the free look period starts. So if you're an agent and you had their policy for 30 days and you just got them to date and sign it, it doesn't start to the day they date and sign it. It's from when they receive the policy, the free look period starts. Now, what is the normal free look period? Is 10 days up to the age of 59 years old. So however old the person is, if they're up to 59, they got 10 days from the day they sign and date to get a full refund of what they paid into their policy. If I'm 60 or older, here's the key. They may say a senior citizen. They may say, a certain age. They may say 65, and you got to know that even if a person is 60, they may say senior citizen, and you're thinking 65, or you're thinking 55 because AARP says 55 and Medicare says 65. For the free look period, if you see the word senior citizen, the age is 60. They will trick it in there because sometimes we think senior citizen of a different age. It's 60 for the free look period. The free look period for a senior is 30 days. So if someone signs and dates and they're 60 and older, they got 30 days to cancel the policy for a full refund. If it's an insurance policy, remember, it's usually just 1 month. 30 days is just 1 month. That means I got the policy, I paid my first month. If I cancel it, they get a full refund of it. Insurance. What if it's an annuity? An annuity is not a monthly payment, it's usually a lump sum of money. If I cancel my policy, my annuity, let's say it's $250,000, within my free look period, I get all the money back. If I'm 59 and under, I got 10 days to do it. If I'm 60 and older, I got 30 days to do it. But what happens if it's an insurance policy and it's day 31 and I'm a senior? Well, you just no longer have insurance, right? You just missed out on 1 month. But if it's an annuity and I cancel after the free look period, then I have a surrender charge. So now we got charges and fees because now you're violating a contract. Insurance is month to month, cancel at any time. A contract is your annuity. They have obligation and so do the client. Here's why. The money that's coming from an annuity is normally coming from a tax deferred account like 401k, 403b, 457, pension plans, TSPs, right? Those tax deferred accounts have rules. One of the most common rule is the 59.5 rule. If you touch that money to your own account, bank account, before the age of 59.5, you're going to be penalized 10%. So that still follows that annuity. If you cancel and you take all the money out, now these rules apply. So you have a 10% penalty that's there. Plus, here's the key, ordinary income tax. That will be on the test. They're going to say capital gains. Is it ordinary? It's ordinary income tax because you've never paid the taxes on that tax deferred account. So whenever you take the money, you're going to pay ordinary income tax. If you touch it before 59.5, that's just the product you put it in initially, you're going to be penalized 10%. So just know those are two rules that come with the annuities because the person started in a 401k. If we can get to them sooner and they go into tax advantage accounts that don't have these rules and penalties, then that's what our goal is, to educate them. But if they're already in that type of account, our goal is to maximize the growth on their money for them. All right, so that's those rules. All right, riders. Here's the common riders that people confuse. You have a disability income rider and a waiver of premium rider. The disability income rider is going to replace the insured's income. So let's say I have a death benefit of $500,000 of insurance, and I add a disability income rider. That says if I become disabled, let's say my monthly amount was going to be $5,000. They would pay me $5,000 a month in income because I added the disability income rider. If I have the waiver of premium rider, they're going to waive the premium or the cost or the payment that I paid to keep the policy going. So two different payouts. One is income and one just pays the premium to keep my policy going because I may have lost my income and at least they're going to pay my premium for me. Don't mix up those two. People mix them up all the time. The living rider we'll talk to is the last part, and it's the long-term care part. We'll talk about the living riders at that point. All right, let's move it on down. We talked about the group plans there. Here's one on the test, and it always confuses people. So here's a group contract where the employer pays 100%. It's referred to as a non-contributory plan. In this particular part, when they ask if it's contributory or non-contributory, stop, take a second, and ask yourself, what is the employee paying? Whatever the employee is paying is going to determine if it's a contributory or non-contributory plan. So if the employer is paying 100%, that means the employee is paying 0%, and that's why it's a non-contributory plan. So most of the time, they're going to tell you what the employer is doing to confuse you. It doesn't matter what the employer is paying. The employee determines if it's contributory or non-contributory. Make sure we get that one going. So that's on the test for sure. Okay, Social Security. The blackout period. The blackout period is going to determine whether someone's going to receive their spouse's Social Security benefits. So it's I'm a widow or a widower, and your spouse's Social Security is more than yours. You are eligible for theirs as long as you don't remarry. If you remarry, you no longer are eligible for their Social Security. So that's the first thing, is you can't remarry. The second thing is they're going to ask two things. Do you have children, and what's your age? And this is just something you guys kind of have to memorize, and you want to go back to it because it is a question on there and it's a guaranteed question to get right. So if I have no children, then they're going to say my age. If I'm 60, I have no blackout period, I can receive his benefits right away. Well, let's say I'm 55 and he passes away and I have no children. I'm in a blackout period. They will say, what is the blackout period? In that case, my blackout period is from age 55 to 60 because I have no children. What if I have children? Well, if I have children, now it becomes how old are the children? As long as the youngest child is under the age of 16, I receive the benefits. As soon as the child reaches the age of 16, they're going to see if I need to be in a blackout period. Let's say my kid is 4, 17, and 18. I will receive the benefits, Social Security benefits, until the 4-year-old reaches 16. Once the 4-year-old reaches 16, they're going to say, let's see what age Melinda is. If I'm 60, I continue the benefits. Let's say I'm at 50. If I'm 50, when my youngest turns 16, I'm in a blackout period from 50 to 60. So again, you guys have to know when the blackout period, and the blackout period is when the spouse does not receive, the surviving spouse does not receive benefits. And when do we not receive benefits? When I'm under 60 with no children, or my youngest is 16 and I'm under 60. And again, it's just something you kind of have to memorize. All right, Social Security benefits. Just remember, fully insured means when do you receive full Social Security benefits? It's when you worked 40 quarters. Doesn't matter how they come up with quarters. What's what? 40 quarters. That's the answer. Guaranteed question. Full Social Security benefits, you worked 40 quarters. Here's that disability question, and that one question. When does someone receive full Social Security disability? The answer is they worked 6 of the last 13 quarters. That means they paid into disability. They may give you a scenario where someone's been unemployed for 10 years. Well, they haven't paid into the Social Security, and maybe they've been disabled and they can't get it now. So if someone becomes disabled, you need to make sure they're applying for their disabilities before their quarters are up. So 6 of 13 is the answer. Just remember that answer. Taxation on life insurance and annuities. So annuity death benefits are not tax deductible or tax free. So remember, that person has paid, that the money has come out of their check before they pay taxes. So the taxes have been deferred. They rolled it into an annuity. Whenever that money comes out, they're going to pay taxes on it. Whether they took the money out or they left it to the kid and the kid takes the money out, the money is going to be taxed. That's an annuity. Your life insurance benefits are always tax-free. Doesn't matter the age. It doesn't even matter the amount. You have a $10,000 policy, it's tax-free. You have a $2 million policy, is tax-free. You have a $50 million policy, is tax-free. Life insurance benefits are always tax-free. Hence, this is why the Rockefeller's family continues to leave generational wealth, because they understand passing money tax-free to each generation. Once we learn the concept, you get licensed, you're going to be changing people's lives. Okay, modified endowment contract, MEC. Just remember MEC, modified endowment contract. That means they violated the code. There's a certain age or a certain amount someone can put into their policy. If they put more than what they're supposed to and they take the money out, they're going to be penalized 10%. So if you violate, if I have a $100,000 policy, I can't put $500,000 of cash in and expect it to be all tax-free. They're going to pay a penalty on it. Some people are okay paying a penalty. At least they don't pay taxes on the money, right? So again, there is a penalty if you modify the guidelines. All right, medical insurance, here we go. Remember, this is a big section. So you must understand this section. Here we go. I'm going to sum it up, go into it, make sure you understand it, because it is a big section on the test. From here down, what we're going to talk about is a big section on the test as well. Medical and then the life and annuities. Those are the two big sections on the test on there. Plus you pay the taxes, right, Daniel? For sure. Penalty plus, well, not if it's a MEC. You're going to pay the penalties on it and for violating and taking it out sooner. Okay, medical expense insurance. Here we go. And whatever the tax bracket. So it doesn't have to be 40. It's going to be whatever that person is. Okay, so medical insurance. There's HMO and PPO. Here's the two biggest ones, right? So here's the key terms to determine which one is going to be which. Whenever you see the word capitation, prior authorization, primary care physician, and gatekeeper, it is considered an HMO. Capitation, prior authorization, primary care physician, and gatekeeper, it is an HMO plan, right? What is capitation? Well, you have a primary care doctor that you go and see. Let's say the insurance company was Blue Shield. Blue Shield pays that primary care physician money for you to keep you from going to spend all the insurance company's money. So every patient you see in there, the primary care doctor gets paid, and they're going to see that patient as many times that patient comes in, and they're not going to get extra. They give them a fee for seeing that patient as many times as they need to be seen. They're going to make sure that primary care doctor gets prior authorization from the insurance company before they allow the patient to go do testing, to go see other doctors, or do anything. They got to go through the insurance company to get it approved. That's why they're considered the gatekeeper. That gatekeeper is responsible for making sure the patient does not go spend all the insurance company money. When you see those words, that's what you're looking for. On PPO, when you see the word out of network or reduced amount, it's a PPO. Out of network or reduced amount, PPO. So how do they work? Here's the story to remember. Let's say I got stomach issues and I go to my primary care doctor. So doctor, I'm having these stomach issues. I give him the symptoms. He gives me medicine, sends me home. So didn't work. I go back to the doctor. Doctor is kind of like now in my chest. He said, oh, that's more heartburn. He gives me more medicine. He sends me home. I'm like, nope, didn't work. I go back to the doctor. It's still not working. I'm having this. He says, Melinda, you just not giving it time to work. Give it a couple of days and let's see what happens. I go back home. I'm like, no, this doctor don't know what they're talking about. I go see another doctor. That doctor comes back and says, yes, Melinda, and he diagnosed me with a medical condition. Even though that primary care doctor was wrong, guess what? I didn't have prior authorization to go see that other doctor. That means that insurance company is going to pay $0. So if you ever see a doctor, get lab, get testing, or do anything, and you don't have prior authorization, they're going to pay $0, even if you were right. Doesn't matter. Here's the scenario of having the PPO. The PPO is going to say it's preferred provider. So let's say I'm in Southern California. Most people know like UCLA and Cedars-Sinai. If you're in like Maryland, Johns Hopkins, you're in Texas, everybody has like big hospitals. And there's always a bunch of doctors affiliated with that. Let's say my PPO is affiliated with UCLA. Now, got the same stomach issues, and I'm about to go see the doctor. My friend says, Melinda, Cedars-Sinai has the best stomach doctors. You should go see them. I said, you know what? I forgot. So now I go see a doctor at Cedars-Sinai. Here's the key. Even though I have a PPO, I'm still out of network. I see the doctor, no problem. They're going to pay because I can go see any doctor I want to whenever, but they're going to pay it at a reduced rate if I went outside of my UCLA doctors. So I can go see any doctor in my network whenever I want to, whoever, lab, everything. But if I go out of the network, they're going to pay it, but it's a reduced amount. So HMO, they're not going to pay nothing. PPO, a reduced amount if I go out of the network. HMO, I must get authorizations due and see everything. All right. So here's this part. We're going to do the two top. PPACA, Patient Protection and Affordable Care Act. You must know that. And they're going to ask you what is all involved or falls under that. The word Medicare, COBRA, HIPAA, the Children's Health Insurance Protection, the program. That means all children are provided health insurance if their parents can't afford it. That's CHIP. We talked about HIPAA. We're going to talk about COBRA and Medicare. Here's COBRA. COBRA, if an employer has 20 or more employees, they're required to provide COBRA. What is COBRA? That means if I quit, get fired, I can continue my group plans up to a certain point, or if I get divorced, they can't just kick me off of the plan. Here's the first time the information is going to vary. The key is up to 36 months is the max you can get with COBRA. But each one of your states have a different number. So the max is the same. Most of the time they may say, what's the max? And it's 36 months. But every now and then you'll get a question to say, how many months do they qualify for COBRA? Make a question mark and figure out for your state, find the information on how many months COBRA is for your state. Because that could be your question. The max is 36 months, but sometimes some states have less than the 36 months. A lot of them do. So make sure you know what that is. California has less than that on there. So Family Medical Leave Act, FMLA. What that means is any employee, if they have a spouse, a child, or parent, you must know the three, spouse, child, or parent, that ends up with a serious health condition and they've gotten approved, can take up to 12 weeks of unpaid time off through their job, and the employer cannot fire them for whatever reason. Even if they didn't want them to take off, they cannot fire you because it falls under the FMLA. Whether someone had a baby, whether someone got cancer, treatment, whatever, as long as you're supposedly taking care of them. Now, you can't be on social media in Dubai saying this is their bucket list. That does not work, right? So again, it's taking time off to care for the family member. Okay, so here's the other part of the medical part. It's a big deal. We might be 3 minutes over, and that's about it. So here's the big deal for the medical insurance. Also, for your state, the federal name is Medi-Cal for low-income people, Medi-Cal. But every state has a name that they use. If you see here, California is Medicaid. A lot of states is Medicaid. There's some states that are different. Make a note. And what is the name of the insurance that's given to low-income people for your state? That is a question you must know. Now, because of the Affordable Care Act, every state has an exchange. The exchange is the one that offers the insurance to be affordable because it's required by the federal government. Make a note, every state has a name who does it. You see here for California, it's Covered California. In your notes, make a note, who does your benefit exchange for the Affordable Care Act? That is going to be a question on there. Now, the rest of it's going to be the same. We break it into metal tiers. There's 3 parts that determine kind of which insurance you want to get. Here's the 3 parts. Copay, deductible, coinsurance. Copay, deductible, coinsurance. Copay paid up front. I go to the doctor, have a $20 copay. I pay up front every time I see the doctor. I go to the pharmacy. I have a $5 copay. I pay the $5 up front. They give me my medicine. That's copay. Deductible means here's a certain dollar amount you have to pay before the insurance company pays. It might be $500. It might be $1,000. You're responsible for the first $500 or $1,000, whatever the deductible is. Not all at once, just as you go. I go to the doctor, it's $100. I pay the lab, it's $25. If I don't go anymore, that's it. If I continue to go the rest of the year, once I reach my deductible, the insurance, coinsurance kicks in. What is coinsurance? Coinsurance is the percentage negotiated between the insurance company and the patient, the client. Here is the coinsurance for the tech. If you're in a platinum plan, the coinsurance is 90-10. Insurance company pays 90%, you pay 10%. That's why it's the most expensive plan, and it has no deductible. So platinum, 90-10, most expensive, no deductible. Gold plan, coinsurance, 80-20. Insurance company pays 80%, patient pays 20%, no deductible. Silver plan, 70-30. Insurance company pays 70%, patient pays 30%. Has a deductible. Here's the silver. They'll ask a question. Which one of the metal tiers changes based off of income? The answer is the silver plan. Which metal tier changes based off of income? The answer is silver. Bronze, big deductible, coinsurance, and 60-40. Insurance company pays 60, patient pays 40%. Platinum, most expensive, bronze is the cheapest. Anyone that's 30 hours or more working, it's required and mandatory that the insurance company gives you medical benefits. All right, we only wind it down literally 3 minutes and we're done. 3-4 minutes. Elimination period, disability. Here we go. 30, 60, 90, 180 days. That is your elimination period or your waiting period. Both of those words are the same. If I have a 30-day elimination period, that means my benefit starts the 31st day. If I have a 180-day benefit, my benefit starts the 181st day. What does that mean? On the test, they're going to say you have a 90-day disability plan. It's going to pay you 90 days of disability. But your elimination period is 30 days. When does your disability start? Well, the 31st day it starts, and I got 90 days after the elimination period. So let's not mix them up. Your elimination period is the time frame you have to wait before your benefit starts. And once your benefit starts, whatever your benefit period is, you get. The elimination period is not included in your benefit. Just had a patient, an agent take the test, and she was like, I'm so glad we went over it. So we're just reinforcing it because she had it on the test and she was a little confused still. Elimination period is not included in your benefit time period. 30 days, I have to wait the 31st day. If I got a 90-day benefit, I get my whole 90-day benefit if I'm still disabled after my elimination period. All right, here's a contributory plan here. Got a question for you guys. The employer pays 0% into the group plan. Is it contributory or non-contributory? The employer pays 0% into the group plan. Is it contributory or non-contributory? Wow, it's non-contributory, non-contributory, contributory, non-contributory, non-contributory. Oh, this is always a good one. Contributory, non. This is where we see if you're still with me here. All right, here we go. So remember, the key was to ask ourselves, there you go, Daniel, based on what, almost, based on what the employee is paying. So if the employer is contributing 0%, that means the employee is contributing 100%. Okay, I thought so, Daniel, because you had the right answer. So that means it's a contributory plan because the employee is contributing 100%. So even if the employee was putting in 1%, it's a contributory plan because you're putting something into it. Now on the test, this is an actual test question that's here. That's what we want to make sure you understand it. It says, if it's a non-contributory group plan, that means the employee is putting $0 in. Whatever the employer is paying for your disability, it's tax deductible to them, but only if the plan is non-contributory. So that means that when the employee doesn't pay anything, the employer gets a tax write-off. But here's the key. The employee is still going to pay taxes on the benefit. So if I got a disability plan and it's paying me $5,000 a month, I don't pay any, I pay taxes on my benefit, but the employer gets a tax benefit write-off. All right, here's the last section, this Medicare and that long-term care, and we're done. Benefit, Social Security disability elimination period is 5 months. All the private ones you pick, 30 days, 60 days, 90 days, 180 days. Disability for Social Security is 5 months. Medicare, Part A, B, C, D. Make sure you read it and understand it. Here's the summary. Medicare Part A is free, and you get it once you're 65. Medicare Part A, free. Hospital coverage, and you get it when you're 65. One of the questions they asked about Medicare Part A is, what does it cover? Well, it's hospital services. One thing outside of hospital services is hospice. Hospice is considered an extension of hospital services. But they'll ask you, does it cover long-term care? No. Does it cover respite care? No. Does it cover adult daycare? No. Hospital services and hospice. That's it. Medicare Part B is optional. You don't have to have Medicare Part B, but it's mandatory to have Part A. Part B is optional, and you have to pay a monthly plan for it. What does it cover? All the doctor's visits, pretty much everything A didn't. The doctor's visit, the lab, the x-rays, right? All of those type of benefits. But here's the key. There's a co-insurance for Medicare Part B. Medicare pays 80%. The patient pays 20%. These are a test question, guaranteed. Medicare Part B co-insurance, 80-20. Medicare Part A and B are considered like a PPO. They call it fee for service. You go see any doctor whenever you want to, as long as they take Medicare, period. Why would you go to a Medicare Part C plan? Well, here it is. Medicare Part C takes your A and B, turn it into an Advantage plan, which will now be HMO. If you have Part C, now you need to get authorization, and you have a primary care doctor who tells you when and what you can do. Why would you do it? Here's a test question. There's perks. Medicare Part C covers things A and B don't. What is it? Vision, hearing, dental. And then they give you like workout stuff. They give you car credit, car share ride credit. So they give you perks that A and B don't cover. Sometimes people take that and will get the authorizations they need. Part D is the prescription coverage. It's mandatory. Whether you have A and B, you need D, or if you have C, you need D. Prescription coverage is mandatory. That is a summary of your Medicare. Here is your long-term care. You have like 4 questions on there. Long-term care, remember we said was a rider, a living benefit rider. You can have long-term care be standalone, or you can have it as a rider, which means if I have $500,000 of insurance, if I pass away, it's a death benefit to my family. If I had a long-term care rider and I qualify for long-term care, they could pay the $500,000 out to my family if I qualify. How would I qualify? They're going to look at what's called activities of daily living, ADLs, guaranteed on the test. There's 6 main ones. 6 main ones they're looking for. What are they? Here they are. Bathing, continence, dressing, eating, toileting, and transferring. Those are your 6. If I can't do 2, that's the answer. 2 of the 6, 2 of these 6, then you qualify. On the test, they're going to throw in vision and hearing. No, those are not the main 6. So if they say all except, it's not vision and hearing. You must know bathing, continence, dressing, eating, toileting, and transferring. Those are the answers. They're going to confuse you with hospice. Long-term care is for the chronic ill. Hospice is for the terminally ill. These people are going to pass away. They just want to keep them comfortable. Pain management, that's hospice. If we're looking at adult daycare, that's going to be people that have functional needs. You can't leave them at home by themselves. They go play bingo, they dance. It's functional. And no, it's not covered by insurance. And then there's respite care. Respite care, here's the key, relieves the caregiver, not the patient. The caregiver gets time off. They're going to send a nurse to relieve the caregiver. That's respite care. Here's 2 answers to oddball questions that's always on the test, and we're done. Medicare covers 3 pints of blood. Medicare covers 3 pints of blood. How many continuing education units do an agent need to do long-term care? That's another state-specific question. Some states are 8, some states are 4. You need to find out how much continuing education do you need to offer long-term care. On that note, I appreciate you guys staying over those couple of minutes. Sometimes we do go over, depends on how many questions the team that asks inside of it. Appreciate you guys taking your license serious on a Saturday, a nice Saturday in most of our states, doing your course. I'll stay back for a couple of questions in the chat, and I'll tell you guys this. If you have questions, make sure you can email me. The email that sent you the email to this Zoom is my email. You can send the questions. I definitely interacted, responded to it. If it's questions I need to direct you to someone else, I will. If it's things we can help you out with, we're here available to do that. So it just doesn't end here. We have an extension. Again, if you wanted some of that information, email it and I'll send it right back to you guys on that part. So I'll stay back for a second to see if there's any other questions in here. If not, we all get to go enjoy the rest of our wonderful Saturday. All right, you guys, very good. I'm glad you appreciate it. Okay, where's information for Excel? Jared, email that and make sure you put Idaho because I do have some. Don't know if it's Excel though. Exam FX for Idaho, yes, but Excel, not sure. But if you're in, I know, because you don't have requirements in Idaho to be in a course. So we can get you study material, but it would be through Exam FX that I could get, but not Excel's on there. But we could, if you want to sign up for Excel course, you can, and you have access to all the data. That was for you, Jared. What was the question you asked about long-term care? So how many continuing education units must a licensed agent do to offer long-term care? It's going to be 8 or 4. You need to find out for your state. Some states are 8, some states are 4, right? So that's that question. All righty, you guys. Looks like we're good to go. Is there another class? Yes, the next one I do is October 4th, and I think it's the 15th, and there's Excel on the 20th. All right, so those are those classes. All right, you guys. That looks like that will do it. All right, you guys. See you soon. Good luck to everyone. Questions, please send an email. I'm more than happy to respond to that.
Recording stopped.